Netflix earnings came out yesterday just after the bell at 9 p.m. and they were actually quite alright, the numbers that they produced over the last 3 months. However, the forward guidance wasn't too great. So as a result, stocks dropped 20% and is currently down for the week 21%. And as of yesterday, is down 19%. So it's been a pretty tough week, and it's the same when it goes across the entire tech board. It seems like there's a rotation at the moment out of tech into more traditional shares, and that's probably one of the reasons why the Nasdaq's not doing too great, and the indices like the Dow Jones, they're holding off just a little bit better. Anyways, in this video, we're going to just look at Netflix. We're going to look at the chart, look at the levels to watch, and look at the income statement and balance sheet and make a judgment from there. It's the 21st of January. My name's Tyrone, and you're watching Minipit. Jumping straight into the video, the first thing that we're going to look at is the balance sheet and the income statement. We'll start with the income statement first, and we're comparing year on year. So we're comparing December 2020 to essentially December 2021. The numbers are good. Revenue was 6.6 billion with a $542 million profit last year, the year before that. And then last year, December, revenue was, or the ones just reported, was 7.7 billion. Turnover with a $607 million profit. So we've seen increases in revenue by around 16%, and we've seen profit after tax rise by 11.9%. The only negative, in my opinion, that you can take away from this is that the profit margin has shrunk slightly year on year. I don't think that that's an issue though, as such, because they're still profitable. And at one point, Netflix was a massive loss-making company. That being said, they're doing quite well, and if we just compare the actual year on year here, just on a side note, they have almost doubled the amount of money that they made from the previous year. So even though we've seen that slight decrease in revenue, I aren't too concerned about anything on the income statement. In fact, it's all really good, and they have met expectations of analysts. Now, looking at the the balance sheet, again, we've seen general improvements across the board. There are some negatives, and probably one of the biggest ones is the cash equivalents, cash and cash equivalents. Apologies. We had 8.2 billion previous year, and now we're sat at 6 billion. So we've seen a 26% decrease there, which is not good. That should be in red. 26% decrease there. That'll do. Total assets have gained though. So we've gained from 39.2 to 44.5, which is a nice 11.8% increase. So even though the cash is down, the assets have become, or they've grown. When we look at content assets, for instance, you've got property, plant and equipment, which has grown. Non-current assets have grown. So generally, we've grown quite all right. Liabilities have kept them pretty good as well. We've gone from 28.2 billion to 28.7 billion, so that's just a mere 1.7% increase. This is really good because what it means is that the actual net equity in the company has grown from 11.6 billion to 15.8 billion, which generally is a nice increase for investors, for owners of the shares, because essentially they're becoming a significantly more cash-rich business, and that's what you want. I would say though, for Netflix, I have done a report on Netflix which is available online, and I did look as well, which I'll just mention in here. It's liabilities to assets ratio. This year they're running at 64%. The previous year they was running at 71.9%. That's better, but that's really high for a tech stock, in my opinion. Companies like Amazon, Facebook, or a lot of the big mega cap companies, usually they're below 50% with their liabilities to assets, and Netflix is quite high on that. But that being said, again, doesn't really justify the 20% drop. Now, if I can find it in here, there is the reason that the stock has dropped is simply because of this here, and it's the paid additions that they're expecting for the first quarter of 2022, and it's quite small. I think it's 2.5 million. I'll just check. So Netflix is expecting to add just 2.5 million subscribers in the first quarter. That is below expectations for the first quarter of 2021, where they did 4 million, so that was January last year. And unfortunately, it's way off analyst expectations of almost 7 million subscribers. So Wall Street was expecting around 7 million extra subscribers on Netflix's platform throughout this first quarter of this year, and Netflix is saying 2.5 million. That's a massive drop, and that is going to make a difference in revenue significantly. So as a result, that is what has caused this sell-off. I don't think that it's overblown, because if you look at Netflix as a whole, let's just say we just look at those numbers. We just look at the numbers again. You're doing $30 billion a year on revenue, and the company is currently worth $250 billion. So they're valued at around 9.5 times their revenue, which in the UK would be an obscene valuation, but in America, it's fairly well, it's not okay, but it's acceptable, because shares are like that in America. But one of the things that I pointed out on my summary here is companies like Zoom, Peloton, and Rivian, they have crazy valuations on the basis of what they will or they may do in the future, and that's what's important. Netflix is going to have a lot of trouble, I believe, over the next few years, because as platforms like Disney, Amazon Prime, Universal, and all the other companies that produce content, they're going to create their own systems, and they're going to pull theirs off of Netflix, which means Netflix is becoming more reliable on their own content. I remember a few years ago I could go onto Netflix and watch Disney films, and now you can't do that. You need a Disney Plus subscription, and I think that over the next 5 or 6 years, the producers and studios will make their own, and it's going to become harder and harder for Netflix. Luckily, they've been able to grow their cash balance and their assets to make sure that they can produce content, but overall, it's a bit sketchy, and I can see why this drop has happened. We'll look at the chart now, and there's a few things with the chart as well that I've noticed, and we got this great growth, which you can't see because it's from when they went public in 2002. We got this really good growth, and then we got to this stage in 2018 at $420. So essentially, for the last 4 years, they haven't grown in value, and we've had a pandemic, people sat at home, and that would tell me that there's a problem. And that's interesting because, well, like I said a few years ago, in 2018 and 2019, when I was watching Netflix, I could watch Disney films, I could watch Universal films or whatever it be, and know that I could just watch them all on Netflix. But because they've pulled the content, I feel like the stock has struggled, and that's one of the fundamental reasons why I think it could be a bit of a difficult stock in the future. Zoom, Peloton, these stay-at-home stocks, Netflix is in exactly the same basket and is going to struggle with exactly the same things as these stocks. If we just quickly look at Zoom, for instance, which was a stay-at-home stock, it's also down significantly. We've got Peloton, which again is also in the same situation, it's down significantly. Palantir is another one, that's down not as much, but it's down from 45 to 14. These stocks, these tech stocks, are getting really hammered, and I don't think there should be a difference for Netflix, because unlike, say, Amazon or Apple or Microsoft, Netflix has a serious amount of competition, and people can take away from the market share. I feel like Apple is an ecosystem, Amazon is just where everybody goes to do the shopping, and Microsoft, obviously, with them buying Activision, which again looks good, they're just, Netflix can't really go out and buy studios that are going to make their content better. They have to create it themselves. So if we just look at the chart, it's difficult to sort of work out where we can go from here. I personally think, and this is my opinion, that we're going to basically get something like what we got in this period here. And as a result, I don't think it's something that I would personally invest in, because unless I was trading it, let's say we're at 407 now, I think that we're just sort of going to go like this, and maybe we'll drift down, and then in a couple of years, maybe we'll come back up. And the reason is this is a really big fall of over 43%. You're not going to get, I find it unlikely that this is going to come back up to these highs anytime soon, just because as everybody's getting vaccinated, everybody's going back to work, people have less time to watch Netflix, and again back to the issue of content, it doesn't really. I just don't see how we can almost double in price from here if we wasn't able to do it in the or we just did it in the pandemic only just where we doubled in price. I don't see how we can do that over the next 12 or 24 months with this stock. Yeah, trading it might be an opportunity where you buy at 400 and you sell at 410, and then you buy it back at 400 and you sell it at 420. But then that's trading, and it becomes, you've got to look at a different sort of ball game as opposed to investing. But as an investment, it could be a bit difficult. Personally, and again, it's not a recommendation, but a stock like Disney would be better, in my opinion, because of the basis that, let's get rid of that, just because of the basis of the parks and the magic that Disney holds with kids. It has more of an ecosystem. You've got Disney Plus on there, which is going to grow. And unlike Netflix, I think that it could be a bit tough. And again, Disney as well is a stock which is down significantly from their highs, and it's actually been looked at as a stock to perform potentially this year. And there is a justification that I could easily see Disney jump from 140 up to this 200 in the next 12 months. But seeing Netflix go from 400 to 700, I don't think that that's going to be justifiable. I do think that we're just going to get consolidation over the next 12 to 24 months. Resistance, just to put the numbers in, resistance sits at about 480 in my opinion, which is this sort of here, this level here, or 480 to 490. Support sits at 391, which is the the February high before we fell. It's also the highs here and just a bit above here, with a cluster high there. I do think that that'll act as a good support, but if we do break that, then we could easily head towards 350, and there is a very a very unlikely but possible scenario that we could go down to the 300, and I wouldn't doubt it, because a lot of the tech stocks have gone down 50, 60, 70% because they're just overvalued, and Netflix is running at 10 times earnings, 10 times its revenue in terms of its valuation, and the profits are getting slightly smaller, and the profit margin's getting worse, and while it's growing slower, so we're getting a flattening of the curve for Netflix, and in my opinion, I think it's going to be a long time before we see these levels up here. So overall, it's not something I would personally add. I would trade it, though. I would buy at 407, sell at 420, and do that. Overall, it's not something that I would I'd look to hold sort of maybe long term, as I think there's better alternatives to Netflix. I've done a report online as well, so if you want to read that, you can. It's on the website. I'll put a link in the description. And thanks for watching.